Hi, everyone. Thank you so much for joining us today. This is a brief overview. So this is a two-part series of a seven pillars of a successful sales tax strategy. Again, this is a brief overview of the seven pillars. We do break these pillars down into separate webinars, and we go through those as well. But this is a two-part series that we're doing this week and next. So thank you so much for being here. Tell your friends, tell your families, tell everyone about it. We love having you at these webinars, and we just need to go over a couple housekeeping items before we get started. So first and foremost, if you are here for CPE credit, we do need you to do a couple of things in order to receive that CPE credit. I'm saying all the words wrong today. So if you need clarification, send me a message, let me know. But you will need to answer the poll questions as they pop up on your screen. You will also need to fill out the survey at the end of this webinar, and that will pop up for you as you're exiting. That survey will also be emailed to you in 24 hours. But again, you have to do both of these things in order to receive CPE credit, and give us a couple business days to get that CPE credit out to you. A couple more important things here to take note of. If you have questions as we are going along, please reach out and ask those questions. You can wiggle your mouse around. You'll see a Q&A button. Use that Q&A button and send us your questions while you have them. We're going to do our best to address them at the end of this webinar or follow up with you via email. So ask them as you have them, and we're going to do our best to answer them. We also will be sending out today's slides and handouts in the chat feature. They are also uploaded to Zoom and will be emailed to you in 24 hours again. And if you have any issues past that, please let me know. I'll help you get your hands on the slides and handouts for today. So let's do some quick intro to, oh, one more thing here. I'm all over the place, Mike. You're gonna have to straighten me out maybe. But pre-recorded webinars. So we offer a lot of our pre-recorded webinars on your own time. They offer CPE credit. You can purchase those one-off. They come with the Salt Vault membership that we have as well, which we are always updating and has a lot of resources, some of which are listed here. If you have any questions about our Salt Vault, please let us know. I would love to answer any of your questions. And now we'll do some quick introductions. First, for Sales Tax and More. Sales Tax and More, we are a full-service consulting and solutions firm, and we have a really great team here of experienced tax professionals who are very dedicated to fulfilling your state tax and related needs. So we do a lot of sales tax returns, sales tax registrations, consultations, research, audit defense, exemption certificate management, and like our name states, more. So if you have questions about our services, please reach out. We'd love to hear from you, and we'd love to work with you. And a quick introduction for our founder, Michael Fleming. Mike's state tax knowledge is very well rounded, and he has helped thousands of companies in all industries and all sizes, and is especially well known for his work in the e-commerce industry. And Mike, I made it through here. I stumbled along. Please take it from here.
Thanks, Ellie. You did wonderful. And as Ellie was saying, today we're going to do an overview of the seven pillars of a successful sales tax strategy. Later on, we'll do a deep dive into each one of the pillars in upcoming webinars. So thank you, everyone, for joining us today. We've got a lot of information to cover. What we're going to go over today is nexus, taxability, rates, use tax, and then we're going to open it up to questions. In part two, we'll be talking about certificates, returns, audits, and registrations. And as always, the worst time to find out that you or your clients have problems is when you're being contacted by a state, whether that is being chosen for audit or just the state reaching out with a telephone call or a snail mail or an email, a Nexus questionnaire. And the reason why that's the worst time to find out is because if you or your clients have past exposure, there are mitigation programs out there. But once the state contacts you, a number of these mitigation programs are off the table. So it pays to be proactive rather than reactive. And Ellie, why don't we get started with the first polling question?
Absolutely. That question should be up on everyone's screen right now. We want to know, how would you rate your Nexus knowledge? Your choices are what's Nexus? You know the basics, you have an intermediary knowledge, or you are an expert, which is a Nexus expert. And quick reminder for everyone, you do have to answer these questions in order to receive CPE credit. Mike, we can move forward. I'll leave this open so answers can continue to roll in, but we have a good mix in the crowd today, all over the board.
All right. So, for those of you who are fairly new to sales tax, let's start out with a brief definition. And nexus, just a fancy term, it means link or connection. And when we're talking about taxes, it's the link or connection with the state that must be present before the state can require you to do anything. For example, before a state can require you to collect taxes, like a sales tax or a seller's use tax, or pay its taxes, like an income tax, a franchise tax, or a consumer's use tax, there has to be some sort of link or connection with that state. And we call this link or connection nexus. Now, this link can be physical, or it can be an economic link. And we'll get into that in a second here. But right now, I want to say that we say that it all starts with nexus, because if you don't have this link or connection, the state can't require you to do anything. So no nexus equals no problems and no responsibility. Now, an economic nexus, an economic link, can be based on sales or transactions. And this is a result of the 2018 U.S. Supreme Court case, South Dakota versus Wayfair. Um, Prior to that, there had to be some sort of physical connection. Now, we can all argue, and quite often did, as to what creates this physical connection, but that is no longer needed. Now, um, it can be based solely on sales or transactions. South Dakota thought $100,000 or 200 transactions was reasonable. The Supreme Court didn't explicitly agree with that. They sort of gave them a wink and a nod, but they did send it back to the lower court to be settled. Unfortunately, they settled the case before this issue was addressed. States never make anything easy. So each state has their own idea as to what can be included in those transactions. Some states include all sales, including non-taxable sales and sales through a marketplace. Other states, exclude sales for retail and marketplace sales, but include all other exempt sales. So we have a chart we're going to go to next that'll help you get through that. But as I said, the states never make anything easy. Now, Missouri was the last state with a sales tax to actually implement economic nexus. So all states with a sales tax now have some sort of economic nexus, including Alaska. Alaska doesn't have a state level sales tax, but they have lots of local level sales taxes at the borough and municipal levels. And if you have more than $100,000 of sales into the state of Alaska, it used to say $100,000 or 200 transactions, but they sunset the 200 transactions as of January 1st of this year. So if that's why you were registered in Alaska, you can now deregister. If you have more than $100,000 of sales, you need to stay registered or get registered in Alaska. And while we're on that, there's a trend away from transactions right now. Now, as soon as I say a trend away from transactions, everyone says we don't have to worry about it. About 35% of the states still have a transaction threshold. So at this point, we still have to worry about it. Couple of points I want to make on this. Number one, this is not an internet issue. We're 6.5 years into this, and my salespeople come back to me and say, "Hey, Mike, I just spoke to an accountant, and he says that he doesn't have, or she says she doesn't have any clients that are subject to this internet tax." Well, tax and nexus are two entirely different concepts. One is not the same as the other. So that's number one. But number two, um, it this economic nexus is not only based on the internet. It's really a multi-state issue. You don't even have to have a website to be potentially subject to this tax. I mean, you can be selling entirely by telephone, by referral, by infomercial, by catalog. You can, be selling by telepathy. Uh, it doesn't matter how you're selling. What matters is, are you selling into multiple states? And if you're selling into multiple states, then you could be subject to this economic nexus. So very, very important piece right there. Number two, it doesn't override any other type of nexus. And here we are again, 6.5 years into this, and I still get calls, a couple times a month from people who are saying, "Hey, Mike, I want to get deregistered in the state of Texas or deregistered in the state of California." And I'll follow up with a why. And they say, well, the state has no transaction threshold. The monetary threshold is $500,000. I'm underneath that. And I'll follow up and say, well, last time we spoke, you still had independent contractors traveling into the state of Texas, or you still had inventory in an Amazon warehouse in California. And they'll say, oh, yeah, I still have that, but I'm underneath the $500,000. And at that point, I have to break it to them. Unfortunately, the physical presence, when it comes to sales and use taxes, not so much for income tax, but a physical presence is going to always trump an economic nexus, or almost always trump. I hate speaking in absolutes, almost always going to trump an economic nexus. So the economic nexus is not going to protect you from any other type of nexus. It's just one more way for the states to get you to do what they want you to do, which is collect and pay their taxes. So this doesn't protect you at all. Now, here's a chart, and we keep this chart updated. It's out on the free portion of our website. It's also a handout from today. A lot of great information on this chart. The column in the middle of the page there is going to tell you what the states actually include in their thresholds. The third column is going to tell you what the thresholds of the state are and what date they changed. So if we look at Alabama, it's a monetary threshold of $250,000, and there is no transactions. The next column is going to tell you what time period the threshold is based on. This is a great time of year. Actually, December, January are better than now, but it's still a great time because um, a lot of states out there say previous calendar year. So you look at 2024, and if you are over the thresholds, then in theory, you should think about getting registered. If you weren't over the thresholds, you can wait until next December, January, February, and not worry about it for the rest of the year. Just repeat the process next year. Now, the next group of states say previous or current calendar year. And if your sales are growing at the same pace they did last year, normal 5, 10, 15%, then you probably don't have to wait until the end of the year also this year. But sometimes there's a situation when sales are exploding. We had one client, this is a perfect example of this, that they gave me their previous year's data. And it was, I think, March or so, or actually it was April. And they gave me the year-to-date data. The salesperson said, no, I'm messing the story up. Ellie, you got me tripping over my words here too. Here's the situation. They were a small client. I looked at their previous year's data, and I told them they had to register in like 2, maybe 3 states. Um, Salesperson said, Mike, they were on Shark Tank. Their sales are exploding. They can't be just 2 or 3 states that you're recommending. So we got year-to-date data, and she was right. We went to total recommendation of 20 states or so that they needed to be registered in because their sales had literally exploded. So if your sales are exploding and the state says previous or current calendar year, you don't want to wait until the end of the year. You want to check it periodically throughout the year because you don't want to start building exposure. You have no exposure before you create this link or connection, but once you create the link or connection, your exposure begins. And if you're passing it in March, like this company did, January, February, March, then that's almost a year's worth of exposure or 9 months worth of exposure, depending on when you cross it. And some of these states are getting very aggressive in going after companies uh, to the date when they crossed Nexus. And that penalty and interest can really start to add up. This is a great chart. Every software company out there, Shopify, the different platforms out there tell you that they can tell you when when you should register because you have Nexus. And I have yet to see software that gets granular enough to accurately tell you where you need to be registered. And Shopify is the same thing, the different platforms. Usually, if you're following, what the software is telling you, you're going to be getting registered in too many states, especially with Shopify, because they're not looking at your specifics. They're looking at what the thresholds are. I had someone come to me and say, Mike, I need to get registered in these 20 states. Shopify is telling me that. And Shopify doesn't put, limiting language on there. They said, hey, you're over the thresholds. So people think they're over the thresholds. Unfortunately, some of them just go out and get registered. Now you've registered in too many states. In this particular example, when I actually looked at the breakdown of their sales, their specific fact pattern, they only had to get registered in like 4 or 5 states. So big savings there. It's, you know, what's included in those thresholds is very, very important. So the software can be a great red flag. It's a great tool, but I think before you actually pull the trigger on getting registered, you have to look at how your fact pattern actually works with these different thresholds. Um, every once in a while, you're not going to be getting registered in enough states if you're relying on the thresholds only, because maybe you or your client, they don't run their Amazon sales through or their eBay sales through Avalara or through Shopify. Maybe that's done totally separate. And now there's not enough information in there to have you crossing a threshold in the states that count those types of sales in the threshold. So relying on software alone is not going to protect you, or it's going to make you too conservative and have you spend money where you don't need to be spending it. So this is a great tool. The software is a great tool as a red flag. It gets you thinking about this, and then you got to utilize something like this. Or we actually have a service. It's called a data review, where we'll go out and do all of this for you, and then make recommendations on where and how you should register. Or, this time of year, sometimes it's not all about registrations. Sometimes it's about deregistrations, like the state of Alaska. We had a number of clients who were registered there just because of the 200 transaction threshold, and that's gone away. And now these clients can deregister, one less state they have to worry about. So great tool here. Now let's talk about some actual physical presence nexus at this point. And the one that I see create more problems than anything else in all the years I've been doing this actually creates more problems even than the economic nexus. And that's third party nexus. Now, some people will call it, agency nexus. There's different names to it. I try to keep it simple, call it third party nexus. And the reason why this trips up so many people, I believe, is that it doesn't make common sense. I mean, if we're trying to think about the activities that we have that create a link or connection in the state, we don't think about third parties and how they can be creating this link or connection for us. But there are two U.S. Supreme Court cases out there, and the second one, Tyler Pipe case, it was a 1987 case, and uh, I'm going to paraphrase the first part here. And the Supreme Court basically said, doesn't matter what you call someone, doesn't matter how you pay them, doesn't matter if they work for you exclusively, if they represent multiple parties, doesn't matter if they do it on a full-time or part-time basis. Here's what's important. Are they helping you to establish or maintain a market? And if they're helping you to establish or maintain a market, then that can be nexus creating. And the reason why that language is so important is because many of the states took that language and they incorporated it directly into their statutes, their rules, their regulations. They use it to provide guidance. The state courts use it as precedent. Um, so, it's really, really important. And since this doesn't actually, come to front of mind when we're thinking about how we're creating, that's why this is such a big problem for so many companies out there. And these are some of the activities. These are not all of the activities that states believe fall under that umbrella language of establishing or maintaining a market. There are more. This is just a partial list here, but rather than get into all of this, I'm going to tell you what we tell our clients, which is if you have someone going into a state or dealing with the general public or dealing with your customers, then they're probably going to be helping you to establish or maintain a market. However, let's say that you have someone who is developing software for you and you're paying them on a 1099 basis. That's probably not going to give rise to establishing or maintaining a market. If you hire a bookkeeper paying them on a 1099 basis, it's not going to give rise to establishing or maintaining a market. So it's not all third-party relationships. They have to be helping you to establish or maintain a market. Now, here's a list of 10 common nexus creating activities for sales and use tax. And this is up on our website, and it's also going to be one of your handouts for today. And when we say common nexus creating, these are the activities that pretty much most of the states, if not all of the states, look at the same way and are going to look at these activities as nexus creating. And that's in contrast to these 12 state specific nexus creating activities. And these activities, the states are going to look at very, very differently. And this also is one of your handouts and will be up on the website. Some sales tax nexus takeaways. Physical nexus is still alive. We still have to worry about this. It's been around a lot longer than the economic nexus, so we, you know, it's here to stay. Economic nexus also here to stay. I don't think that it is going away. A lot of people thought that Congress was going to step in or that the Supreme Court was going to somehow modify this. The states, for the most part, implemented this pretty well. I don't think we're going to see the Supreme Court step in. And Congress, by the way, the last time they waded in on a nexus case, it was an income tax case, and it was in 1959. And at that time, they said this is a temporary solution, and they came out with Public Law 86-272. It was in response to the Northwestern Cement case. And when they came out with this public law, they said that Nexus is so complex, and this is so important that we've got to, do studies and power panels and commissions. And as soon as we figure out a better solution, we're going to let you know. And 1959, what was that? 66 years ago now. And we still have this antiquated temporary solution out there. So, If we're waiting on Congress, then uh, we're going to be waiting a long time, in my opinion. Congress doesn't always get a whole lot done, especially when it comes to, sales tax. This U.S. Supreme Court reminded them in 1992 and a couple other times, hey, this is your, domain. We've, answered a bunch of questions. And again, Congress didn't do anything, and that's how we got Wayfair. Finally, the Supreme Court had to step back in again. They said that in 1992 during the Quill case, hey, Congress, you need to do something about this. Anyway, I digress. Independent contractors, major risk factor, and real or tangible personal property owned or leased in states, and this includes inventory, also a major risk factor. And it can even be inventory at an Amazon warehouse. Can create nexus for both sales tax and income tax. Some of the states have changed their opinion on that since Amazon began collecting the tax. However, most of the states still think of that as an issue. And California in particular is extremely, extremely aggressive. Here's some ways that states find you and your customer or your clients. Uh, the biggest way, if they're selling on a business to business basis, is the auditing of the customers. When an auditor comes out, they're not just looking at whether you're collecting the right amount of tax and that you're remitting all of the tax that you're collecting. They're also looking at your purchases. They want to make sure that when someone doesn't charge you tax, that you're self-assessing and remitting it to the state as a consumer use tax, because just because someone doesn't charge you tax doesn't mean that it's tax-free. You're responsible for that tax sale. And when they're making sure that you're doing this correctly, it's a perfect opportunity for them to be prospecting for leads. Some states, very formal process. The state of Texas, you got to fill out a lead card for every invoice from to actually a unique invoice. If one of your vendors gives you 10 invoices, you don't fill out 10 lead cards, but for that one vendor, you are going to have a lead card. And now you're on a list. And they have units out there called discovery units who follow up on these leads. It may be 3 months from now, 6 months from now, maybe 2 years from now. But the whole purpose of these discovery units is to find taxpayers they think should be paying their taxes. So you don't want to be on a list. Information sharing with other states or the IRS, really the IRS in particular. If you pay someone with a 1099, which we often do for third parties, state can go to the IRS and say, can you please tell me who's received a 1099 in my state? And then they compare it to who's registered for other types of taxes. Your competitors, your customers, sometimes it's done maliciously. Sometimes it could be, you didn't charge them tax. They call the state and say, hey, my vendor didn't charge me tax on this. Do I need to pay use tax? And next thing you know, the state's saying, who's your vendor? Some states purchase lead lists. Some states just ask companies. A number of states have asked Amazon for who has a list of for a list of who has inventory in their state. Web surfing, some states do it manually. Others have software called web crawlers that look for certain terms that make it look like you're selling into their state. So these are just some of the ways that states find you. Ellie, you want to go to the next poll question, please?
Absolutely. That question should be up on everyone's screen right now. We want to know, what about sales tax nexus concerns you the most? And quick reminder for everyone, you do have to answer these poll questions in order to receive CPE credit. Your choices here are nothing you have down, economic nexus, third party, travel, and other. And Mike, most people are responding economic nexus and third parties. I'll leave this open again and you can move forward, and we'll give people a chance to have their answers roll in.
Yeah, and those are the two most common answers, economic nexus, because it's relatively new and it's constantly changing. So that's one that's always up there, and people are concerned about that. But third parties, this takes us all by surprise. I've talked to many, many smart people out there, and this is just a blind spot for many of us. So those are the two big ones. All right, let's go to taxability. And taxability gets very, very granular. People often call up or even on webinars like this, they'll ask me for, hey, is this taxable in this state? And, if you're selling widgets, that's an easy answer. But unfortunately, the states have their own ideas of what's taxable and what's not. As examples for how granular they get, um, candy containing flour, we're going to talk about food, one of my favorite things. In Iowa, candy containing flour is not taxable. So if you go out and get a Twix bar, which is candy coated pretzel for the most part, that's not going to be taxable. But if you get a Hershey's with almonds, that would be taxable. So very, very granular. In California, if I buy a bottle of still water, no bubbles in it, that is not going to be taxable. But if I get me a bottle of San Pellegrino or um, one of these other bottled waters that have bubbles in it, that's going to be taxable. Very, very granular. So we're going to talk about this at a very high level. Tangible personal property, that's something that can be seen, touched, felt, smelled. It's something that's perceptible to the senses. But it's not going to be real property. It's not going to be intangible property. So tangible personal property by default is generally going to be taxable. Now, when I talk about tangible personal property, it's that personal that gets many people. Tangible personal property could be that airplane. It could be that tractor. It's not just your wallet or your watch or your belt or your purse. And a lot of people, when they hear personal, that's what they start thinking. But remember, it's anything that's perceptible to the senses for the most part. So it's going to be taxable by default unless there's some sort of an exemption, and there are going to be many, many exemptions out there. Exemptions can be by item. They can be by use or by entity. When an exemption is by item, sometimes that's called an exclusion. So groceries is a good example of an item or an exclusion that's exempt to everyone. When it's exempt to everyone, then you don't have to worry about exemption certificates. But groceries are not exempt in all states out there. So each state, again, has their own ideas. Um, by use, an exemption by use could be a manufacturing or resale exemption. Anything used or consumed in the manufacturing process is exempt in many states. Anything purchased for resale is exempt in all of the states that have a sales tax that I know of, with the exception of Hawaii. Then it's just a reduced rate. And then by entity, the federal government or sometimes municipal governments are types of entities that are often not subject to tax. A lot of people say, well, municipal governments aren't subject to tax. Well, sometimes they are in the state of California or the state of Hawaii. So we can't make broad sweeping statements sometimes. It gets very, very granular. Now, TPP is often stretched by statute. For example, electronically delivered software, I don't think of that as being something I can touch or feel or being perceptible to the senses. However, a number of states by statute define that as tangible personal property. The same thing with electricity. So sometimes the states are stretching the boundaries by statute. Tangible personal property incorporated into real property is generally not taxable to the customer. Each state has their own rules as to when it's not taxable, and real property generally not going to be taxable. And that's why if you're taking tangible personal property, making it a part of the real property, that's why it wouldn't be taxable. So, um, if it's permanently affixed, if it loses its identity, damage to the property if removed. These are some of the terms you're going to hear from different states on how to determine if it's being incorporated into the real property. Now, when it is, doesn't mean that it's tax-free. It just means that the person incorporating it becomes the final user, the consumer, in most instances. So contractor generally considered the final consumer and is generally responsible for paying the tax on their purchases. And even exemptions there. Some states, if you're doing work for an exempt entity, then you can utilize the exemptions of that. Not all states allow that, though. All right, so TPP used or consumed in manufacturing, generally not going to be taxable. However, every state has a start and a finish to the manufacturing process, and they're not all the same. Each state is going to define that process differently. And a common term you're going to see out there is predominant usage. Now, I'll give you an example. In the state of Virginia, we had a client one time, and it was they were being audited, and they did not pay tax on their purchase of two cranes. And the state of Virginia said, "Well, you owe tax on these," and we had to, argue and say, "Hey, this is definitely used in the manufacturing process. It's moving something from this part of the process to this part of the process." So we got that one excluded from the audit. The second one was maybe 25 yards from the assembly line, but they were using that crane to take the finished product as it came off the assembly line and load it into a truck. And that one was after the manufacturing process had finished, and therefore that crane, they should have paid tax on it. We could not get the state to budge on it. So again, very, very granular. Now, services and, contrast to tangible personal property, they're generally not going to be taxable by default. And services generally must be specifically enumerated, in other words, spelled out in order to be taxable. Now, as soon as I say services are not generally taxable by default, most people say, well, services just aren't taxable. And our salespeople are always coming to me and saying, Mike, this person believes that no services are taxable. And that's not true. Every year, more and more services are becoming taxable by more and more states. And I don't know of any states out there that don't tax at least some services. And I get challenged on that. And then we have to go back and say, okay, here's the services that your state taxes. So even California, which doesn't tax very many services, will tax some services. And sometimes, it's the same service, but for different situations, like if it's associated with the sale of tangible personal property. California used to have a great example up on their website. It was about drapes. And if you went in and bought a new pair of drapes and you had measurements, for your bedroom, and you gave them the measurements, and they did uh, the tailoring of these drapes, the customization, to make them fit in your bedroom, that was a taxable service. Now you went home and you hung those drapes and you didn't like them, you hated them. So the next day you went down to the local tailors or dry cleaners, whoever's, altering uh, items. And now it's the same drapes, but they're not new, and it's not associated with the sale of tangible personal property. So that same service on the same item is now a non-taxable service. So sometimes, again, I'm going to fall back on it. It gets very, very granular. The timing, the specific facts of the transaction can make something taxable. A lot of times when a non-taxable service is combined with tangible personal property, that's what we are just talking about, it becomes taxable. And sometimes a non-taxable service becomes taxable when sold in conjunction with taxable services without being separately stated. So if you're lumping things together, it all becomes taxable. Some states if you're separately stating it, will allow it to remain non-taxable. Now, these 4 states, these are different than when it comes to services in the other states. Remember, the other states, we said that services are generally exempt unless they're specifically identified. But in these 4 states, it's the exact opposite. Most services are going to be taxable unless they're specifically identified as non-taxable. Hawaii and South Dakota even tax accounting and legal fees. So if you've got, multiple, a lot of nowadays we have clients all over the country. So if you have clients in the state of South Dakota and you're doing $100,000 in billings there a year, you may have to start charging tax on your accounting fees. All right, so the true object test, this is something we hear about all the time when it comes to services. And sometimes when a service and tangible personal property are sold together, we need to do a true object test. And I think this is a great example. These items are both found on construction sites very often. One is a dumpster, the other is a porta potty. If we look at that dumpster, a lot of states are going to look at this and say, well, you know, what's the customer's intent? What did they want to purchase, a good or a service? And, that dumpster makes the taking away of the garbage pretty easy, but you don't need a dumpster to take away the garbage. I mean, maybe you have a bunch of cans and, you're just interested in that garbage leaving the site. So in that instance, um, that's the rental of the tangible that dumpster is often not taxable. Whereas in the porta potty, um, yes, there's waste removal in that also, and I've been to some where I wish they were removing the waste. Um, but it's not just the waste removal that you want. You want those 4 walls. You don't want to sit down and have the whole world looking at you do your business there. So in that one, you're actually renting the tangible personal property and not the services. And therefore, many states are going to look at that as being taxable. So what's the true object? Was the customer's intent to purchase a good or purchase a service? And most states look at rentals or leases as a type of purchase. All right, so services are often viewed through the prism of how a state taxes. For example, in Texas, website design and hosting, I never think of data processing. I would never put those 2 things together. My mind just doesn't work that way. However, the state of Texas does. And for the last 30 plus years, they have said that website design and hosting is actually data processing. So if you're just looking at the big print and looking at the enumerated services, well, website design and hosting, they're not, one of the big picture items. Um, you have to look at how Texas is actually interpreting what the statute says. What's the supporting documentation out there? And this one trips up a lot of people because sometimes people are going very quickly and they say, oh, it's not on the list of enumerated services, therefore it's not taxable. We got to dig deep sometimes. Another example, South Carolina, they couldn't figure out how to tax software as a service, so they tax it as a communication service. So it's not just the big picture we got to look at. We got to do that digging. Here are some commonly taxed services. Not all states are going to tax these. Each state, as we said, is going to be different, and these aren't the only services that are taxable. These are just some very commonly taxed services. Now, digital property, this is going to vary widely by state. And some states do a good job of defining digital property, some do not. When we're talking about digital property, most states, not all states, but most states are going to treat software differently than digital property. They look at it. Remember earlier we said it's often defined as tangible personal property, even when downloaded. So that's going to be a little bit different than digital property. This is an area that's changing quite rapidly. New states are adding digital products all of the time. As you know, our economy changes out there. We're moving more to digital goods and services. One of the big ones out there that I see tripping up people the most is what's called digital audio visual work, which is videos or movies. And this was primarily designed to get companies like Netflix, but it's catching up a whole bunch of unintended people out there. For example, if you're doing webinars and you have pre-recorded webinars, and you are selling those, then you may be subject to collection of tax on that pre-recorded stuff. The live stuff, not so much. The pre-recorded stuff, yes, because the pre-recorded stuff is a digital audio visual work in many states. Ellie, let's do the next poll question.
Absolutely. So this is the trickiest question of the day here. Will you be joining us for next week's webinar? We hope that you do. It'll be part 2 of this brief overview of the 7 pillars of the successful sales tax strategy. Try to get it right on the first time. You do have to answer this poll question in order to receive CPE credit. So Mike, if you want to move forward, I will leave this open for everyone and we'll let answers roll in.
Okay. Let's go to rates real quick. And I don't know, anyone here is free to check all these different colors. I'm colorblind. I can't even see all the different colors, the different shapes. But each one of those is a taxing jurisdiction and has its own little rate. I've heard estimates anywhere from 7,500 to 15,000. The number we use is 13,000. Um, so now that you got to collect taxes, many of you all across the country or your clients do, doing this manually is almost impossible. I think you have to use some sort of automation for this. And if you are doing it manually, or what logic do the states follow or the software follow? How do they determine which state's rate to use? Well, for interstate sales of tangible personal property, delivery state is generally going to determine the state rate to use. So whenever anything's crossing a state line, that makes it an interstate sale, and it's the delivery address that we use. For intrastate sales, for sales that never cross a state line, we use origin or destination-based sourcing, depending on the state. When we say origin, that's where it's shipping from. That's how you lose that. Now, this only is for local taxes. Okay, it's not crossing a state line, it's staying inside the state. So how do you determine which local tax inside that state you use if you're shipping from one point inside the state to another? And it could be origin or destination based. Now, the software companies out there make too big of a deal over origin based, and they make such a big deal out of it that on the last webinar I did, when we were talking about origin based sourcing, someone said in the question and answers at the end, well, I don't have to worry about anything you're talking about because I'm in an origin based state. No, it doesn't work that way. That only covers you for inside your state. When you're selling to another state, if you're over a threshold or if you have a physical presence, then you got to be collecting the tax. That's basically what we just said here. Origin uses the address of the business. Destination uses the address of the customer. Way too much focus by the software companies. Digital property services are generally sourced where the benefit is received. Digital property, there's a hierarchy of knowledge that's known at the time of the sale. Here's an example of a hierarchy of knowledge. You start at number 1 and go down the list, and you got to be honest when you're doing this. You can't get to an answer just that's going to benefit you. I mean, it actually has to be unavailable to you. And what happens is a lot of online sellers, the information provided at the point of sale ends up being what's used. How to figure out the rates? You can call the state, check the state website. There's free rate lookups out there. You can use a rate table that you can purchase from someone or you can automate. And let's go to use tax. Now, historically speaking, widely believed that interstate commerce could not be taxed directly. So back in the 30s, when the first modern day sales taxes were introduced or reintroduced, you had companies setting up on the border of a state and selling into the state, and it created an unfair advantage for those companies on the border. Like I live by Texarkana. Texarkana, part of the city is in Texas, part of the city's in Arkansas. So if you set up on the Arkansas side, selling into Texas, you didn't have to collect the tax. So they came up with this concept of a use tax. And the use tax is not a tax on the transaction. A use tax is for the complement, it's complementary to the sales tax, and it's for the storage, use, or consumption in the state. So if it was being used in the state of Texas, then the tax was due, and the sellers still had to collect the tax if they had nexus. Now, maybe it's semantics, but it was a way around the law and it leveled the playing field. Now, so technically speaking, historically, sales that never crossed the state line were the only ones that were subject to sales tax. Sales that do cross the state line were technically subject to this use tax. Now, in 1977, we had a court case called Complete Auto Transit. It was a Supreme Court case, and the Supreme Court at that point said, yes, states can tax interstate commerce so long as it meets a four-prong test. Pretty easy four-prong test. But at that time, the lines blurred. And nowadays, the average layperson doesn't see a difference between sales tax or use tax. They just know that they're they're paying a tax. And even to many companies, they just knew they were collecting a tax. But it does make a difference if you're the one doing the registrations, if you're figuring out tax rates, if you're filing the returns, because how you're registered makes a difference. And since the Wayfair case, this has changed even more because in states like Colorado, if you didn't have a physical presence there, then you were collecting the out-of-state use tax. And now, if you have a significant economic presence there, you have to collect the sales tax. So this has been blurred even more nowadays. Consumer use tax, only exempt purchases are tax-free. We talked about that. If a seller does not charge you tax on a taxable sale, you're required to self-assess, accrue, and remit it to the state. This goes for individuals as well as businesses, but individuals are not audited, so not everybody is so honest that they're going to remit the tax to the state themselves. That's how come we ended up with Wayfair. The states thought they were losing out on a bunch of money because the individuals weren't doing this on their own. And this is either the number one or number two problem for companies in an audit. If you have to worry about certificates, that's usually the number one problem. If you don't have to worry about the certificates, the use tax is usually the number one problem. So consumer use tax, you got to have a system in place. You can review all invoices. However, if you're making a lot of purchases, that's usually not possible. So sometimes you want to just review all invoices over a certain dollar amount, and you do a sample on the smaller invoices. And there are some vendors out there that you know don't get things right all the time. So you may want to target certain vendors. You can use a manual approach, an automated approach, or a blended approach. We think a blended approach is the best way. There is no perfect solution, despite what the software companies tell you. Hey, just use our consumer use tax software and you'll have no problems. Unfortunately, you'll have to make so many changes to your accounting procedures. It just doesn't work. So Having a blended approach, the tools, the software can make your life easier, but I still think that you need a person helping you with this. And by the way, you're not looking for a perfect solution. Perfection is not a realistic goal. You just want to catch the biggest issues. Sometimes if you're trying to be perfect, you'll spend more money on trying to reach perfection than you would have saved if you had missed a couple of these items out there. So you got to strike a good balance. And it's not always about paying tax, especially when you're targeting certain vendors. Sometimes it's about not paying tax because when you're reviewing your purchase invoices, you're going to see that people sometimes are charging you tax when they shouldn't be. So sometimes it's about tax refunds or short paying invoices. So it's not always about paying tax. I think all companies should be reviewing their purchase invoices. This is the number one or number two problem for large assessments out there. And it's also a way to avoid paying tax unnecessarily. So no matter what approach you use, this is something that more of us need to be paying attention to. And at this point, Ellie, why don't we open it up to questions?
Yeah, absolutely. Before we jump in here to this question, if you have one, just remember, wiggle your mouse around, find that Q&A button, and you can send in your questions. So, Mike, what is the best way to resolve sales tax collected in wrong states? My client collected sales tax in 27 states last year to the tune of $75,000. States they are not registered in and do not have economic or physical nexus. This was due to incorrect settings in QBO. I'm assuming refunding the tax to customers is the correct approach, but the client feels uneasy about telling his customers he messed up. Could you please weigh in?
All right, so tax collected, not remitted is the cardinal sin of sales tax, and they call it unjust enrichment. It's really a nice way of saying you committed fraud, because in most states, that tax money is not your money. It's either your customer's money or the state's money, and you're collecting it in trust. So keeping it, usually not a good idea. Refunding it to your customers, one of the best ways to do this. The second way to do this would be to uh, get registered, remit it to these states. Unfortunately, most of the states don't let you just remit it to them. If they did, that'd be a simple solution. There are less than a handful that will do that. And then once you get those taxes remitted, then you can deregister. Um, or this is not the way states want you to do it. It solves one of your problems about keeping it in your pocket and spending it. It's not unjust enrichment, but I've seen clients go ahead and remit it to their home state. And this way it's off their books and the state has it. Now, the problem with that is if one of these states ever finds out that they were collecting it and didn't remit it to the correct state, they may come back after them for that tax. And a lot of times you can get it refunded from the state you remitted it to, but that's extra work, number one, and you got to watch the statute of limitations. I had an instance where a company in California was doing this, and the state of Texas found them, and they had remitted everything to the state of California. They told Texas, "Hey, just contact California; they'll give you the tax." The state of Texas laughed at them and said, "No, that's your problem. We want our money. We want the last 7 years of back tax plus penalty and interest. You go to California." Now, the problem was um, the statute of limitations is 3 years in California. So they could only get 3 years back. So 4 years of tax, which was already collected from their customers. So they couldn't go to the customers even and get it. They just had to eat that. So there's problems no matter how you do this. Uh, Sometimes if you have thousands of transactions, small dollar items, the first one returning it to the customers, not an issue. But if you have larger transactions and you can fairly easily get it back to your customers, I would do that. Sure, you don't want to say we made a mistake, but hey, sales tax is so complex. People will understand you made a mistake and they like getting money back. So I think that their gratitude for you fessing up and giving them some money would outweigh the potential negatives there. But that's just my opinion. But I definitely would not just sit on that money, keep it in my bank account, or spend it.
All right. And before we go to the next question here, Mike, I just want to say thank you for coming for anyone who has to head out right at the top of the hour here. We really appreciate having you here, and we hope to see you next week. And Mike, is it the seller's or purchaser's responsibility to make sure use tax is paid?
What's our favorite answer, Ellie, when it comes to sales tax?
It's gonna be it depends.
Yeah, it depends. So, you could have the responsibility to collect and remit the use tax. It's depends on the state and what they call their taxes. Sometimes you're not collecting a sales tax, sometimes you're collecting a use tax. And so it could be the seller's responsibility. If the seller doesn't collect it, then it would be the buyer's responsibility. And the buyer's supposed to self-assess and remit it to the state. Now, states sometimes they're not supposed to collect the tax twice, but sometimes if the buyer and the seller are not talking to each other, then the tax ends up getting collected twice because they're collecting it from the buyer and then they're turning around and collecting it from the seller. Now, this is in general. There's some states that have specifics that are going to be a little bit different from what I just told you, but in general, that's the answer. It's going to depend, and it could be one or the other or both.
Thank you so much, Mike. And I just want to say to everyone here, we have a nice thank you here, Mike. But I want to say to everyone else, if you are an accounting professional, a CPA, we do offer a meeting without your client if you want to speak. Now, your client cannot be involved, but if you go to our website and you look at the consultations page, there is an option to speak to our team if you are an accounting professional. So, Mike. I don't think we have any more questions about any questions for you in here. I think the rest of these are for me. Anything else you want to add in?
No, I just appreciate everyone's time today and hope this was beneficial for you. And we hope to see you on the next webinar. Bye bye, everyone.